Awesome. All right. Good morning, everybody. Thanks for inviting me to join the group and share some insight on the lending side of things and what I do when I'm working with buyers and how we can all work together, and some information that'll be helpful for you when you're talking to buyers and prospects on the phone. So the first thing that I always start off with is the pre-approval process. It's important to get people comfortable with what I'm going to be asking them, what the lender's going to be talking about, and there's three basic topic areas that are super important to get out there and get people familiar with, and it can really help you in the conversations and the objections that you might have when you're talking to these buyers on the phone. So the first one is credit. The three areas are credit, income, and assets or down payment. So credit, income, and down payment. The first one is credit. And the way I approach the question as a lender might be a little bit different than your conversation, but here's what I'm going to ask them. I'm going to say, hey, do you know what your credit score is? Have you looked online? Have you signed up for something like Credit Karma? They'll usually have a range. Sometimes they're a little shy about it. They might say, oh, it's this or this. And I say, well, it's just important for me to know the range so that we know, number one, what we need to do to get you qualified. And number two, the impact that it's going to have on your credit score. So what most people think is that their credit is going to just kick them out from qualification immediately. There's a lot of myths. I think one of the myths that I talked about last time I presented was with VA and down payment and all these things. A lot of people still have in their mind these misconceptions that, oh, if I have a 600 credit score or 620 or 680, maybe I can't qualify. And the funny thing is that I'll talk to people every day and I'll say, do you know what your credit score is? They'll say, oh yeah, it's not that great. I've been working on it. I'll say, well, what range is it in? Oh, it's a 720. I've been working on it for years and I can't get it above that. And for some reason, people think they need to have an 800 credit score or it's crappy credit. So that's an important thing to remind people to dispel these myths and these objections that they put into their own head, that they may think they have a terrible credit score, but it may not be anything to worry about. And anything really above 720 is an A+ in the lending world. It's easy to get them qualified for most programs. But all the way down to 580, there are programs that can help people. And if they have strength on one of the other two areas that we're going to talk about, then even the lower credit scores, there's solutions for people to get into homes if they have a stronger down payment or income situation. So that's one of the basic things with credit. The other thing that's super important on credit that I'm going to get into when I talk to these prospects and buyers is all the other things on their credit report. So another misconception that people have, and the way the conversation usually goes, I'll say, okay, great. So that's your credit score range. That's going to help me know what programs you can qualify for. The other super important thing about your credit is what's on there with monthly payments. And people will start to say, oh, well, I have this student loan or I have this car payment or whatever, and it's got this really high balance. I've got, $60,000 in debt. And I don't usually care about that. What I care most of all about is the monthly payment. So especially on student loans, maybe the monthly payments are low, they're deferred, they're in some kind of a income-based repayment plan that's lower than a typical amount would be for some high balance. So it's important to, again, get these objections that buyers are putting on themselves, things that they've heard, misinformation, that if they have a lot of debt, it's not going to necessarily disqualify them. It's more about the monthly payment. And a quick rule of thumb that I always tell people, especially when it comes to car payments, because that's the big one. Cars have high payments, no matter what the balance is. They could be paying off a car for 5 years and they still have this $800 payment on their credit. So there's coaching that we can do there to help them qualify for more on the mortgage side. But if they have a high monthly payment on their car payment, then what I usually say to them is, did you know that for every $500 in payments, whether it's a car or anything else, that's impacting your purchasing power by about $100,000. So if we can do something to pay off that car, maybe sell it to a family member, sell it to somebody else, so that payment is not showing up on your credit anymore, that's going to increase your purchasing power tremendously. And that simple rule really opens people's eyes to say, for every $500 in monthly payments, not total debt amount, but in just those monthly payments, whatever it is, that's hurting you $100,000 of your purchasing power. So that usually gets people's wheels turning on, what can I do to get rid of this payment? Can I pay this car off that I've got $3,000 left, but it's showing up as a $500 a month payment? So all these little things to just help people get more comfortable with their financial situation and dispel the myths that they put into their own heads when it comes to credit. So that covers credit score and monthly payments. Also, credit history is super important. Did you have a
I
question?
was going to say that's huge. I never heard that before. $500 and $100,000.
Yeah, that usually makes people go, wow, I can get rid of this. I can pay this off in the next 2 months. I can shift this over. You know, this is only on my wife's credit. Maybe we can do it in my name. So all these little strategies of just planting the seeds of the misconceptions that people have. I call them the, you know, we all talk about objection handling and objection in sales, you know, the things that people are going to ask us to try to throw us off our game, or the responses we need to have. But these are really self-imposed objections that people have because of all the misinformation that's out there. So thanks for that, Ron. I agree. That's one of the most super powerful topics to cover with them, because then it really opens the door of getting them thinking, wow, I could qualify for more if I just shift this around or pay this debt off. So thanks for that. The other part on the credit is the credit history. Of course, the payment history has a huge impact on the score. So we have to look at their payment history. If they've been late on mortgages and that kind of thing, it can have an impact on their qualification, but that's not all the details you need to get into, but just those two simple things about dispelling their myth of what a good credit score is, and also what their monthly payments are and how that impacts their qualification. Those are two things that you can put in your arsenal and keep in mind when you're talking to people that say, I'm not ready or I might not qualify, and you can ask them about their credit. So that's the first one. Any other questions or comments on that topic? Okay, so the next one I'll move on to is income. That's the second pillar of the pre-qualification. It's credit, income, and down payment. So the second part is income. And there's a lot of different programs to solve for different income issues. There's, you know, for people that are seasonal workers or don't have social security cards, there's ITIN programs. People can qualify even if they don't have a social security number. Again, they might need a stronger credit score or down payment. This all works together. But people that don't think they have any chance of qualifying because of their income situation, believe me, there's solutions out there, and I love to solve for these complicated income issues. One of the most important things on income is that even if people have been out of work, we're always going to look at a 2-year job history. And the rules and most of the underwriting for the loan programs is, as long as there hasn't been a gap of 6 months, if somebody's been out of work, then if they're going back to work, we can still count that as continuity of income. So we're looking at 2 years. People might say, oh, you know, I'm getting ready to go back to work. I'm just moved. I don't have a job yet. There's a lot of different ways that we can approach this when it comes to income challenges and job challenges. And a lot of people don't know is that you can qualify for a mortgage based on an offer letter. So, you know, say you left a job 3 months ago, you're going back to work, and you have an offer letter. I can base the pre-approval off of that offer letter. Sometimes we can't close the loan until they either get a first paycheck or they've started their first day of work. Starting the first day of work is one of my favorites, because most people think, oh, I have to be at the job for a certain amount of time. No, if you have an offer letter and we can call your HR department, this has happened a couple of times for me with Tracy police officers. They move around, they, you know, come from a different area, they get hired in a new office, they're doing the same kind of work, they've been off for a couple months, or they're going through their screening, which takes a while. We can verify from the HR department, yes, they reported to work today as their first day of work, and then we can close the loan on that day. So there's all these different things that people get myths in their head that they disqualify themselves without talking to a professional like everybody on this call, like me, to be able to help them solve these issues that they think that they can't qualify. And the biggest part of this whole process, as you guys know, is to get all these financial questions answered, especially in this market, so that we can be ready to present a strong offer, that the lender has looked through everything. We know that the loan is going to go through, because that's how we build the confidence in all these relationships that we have and get offers accepted and successful transactions and happy clients. So the other thing I wanted to cover on the income piece is just a quick rule for you guys to use on how to qualify somebody based on their income. If you get into those discussions and you talk about how much money they're making, you know, there's all different kinds of conversations you have that when you're going through your initial discussions about people's jobs and kids, and you get to know your clients really well. So if they're talking to you about the money that they make and thinking what they can qualify for, again, I like to use these simple thumb rules. And if you've got somebody who's making, we'll just say $10,000 a month as an easy number to do math with, the rules for lending are we can use about 50% of that. There's different guidelines for different programs, but a good place to start is 50% of that money that they're making each month can be used for their total debt. And that's where these car payments and everything come into play. So if somebody's making $10,000 a month, we cut that in half. We say, okay, we can use $5,000 for your total debt payments. If they've got a car, whatever, we have to take that out. So let's assume they have no other debt. So if they've got $5,000 a month that's available for the mortgage, and that also covers taxes, insurance, and PMI. So right off the top, I'll take another $1,000 off for taxes, insurance, and PMI, just talking rough numbers for what's typical in our market. Obviously varies by price range, but now you're down to $4,000 that can be used for the rest of the mortgage payment, the principal and interest. And just like that rule of $500 of a debt payment equates to $100,000 of purchasing power. So if they've got $4,000 left over, then the quick math on that is they could qualify for up to an $800,000 mortgage. I mean, these numbers work pretty easily just to get people's mindset right that, oh, I'm only making this much a month. How much can I qualify for? So let's cut that in half. If somebody's making $5,000 a month, they don't have any other debts, then they can probably qualify for close to a $500,000 mortgage minus the taxes and insurance. Maybe you're down to $400,000 mortgage. So, all these just quick numbers to have available to help people get comfortable with what they think is a hopeless or difficult situation. We can help build the confidence so that they can move forward with the process and get the real answers to their question. That's the biggest thing, is there's all these myths that people put in their head, or misinformation, or they need 20% down, or whatever it is, that the more we can help them feel comfortable with their current situation, that there is a solution, the more successful we all will be, and we'll have happy clients that we're solving problems, not just trying to sell them something. So that's really the key there. The last piece on the income that I wanted to cover is self-employed people, right? There's this gig economy. There's people doing Uber and Lyft and Airbnbs and all these other situations, which surprisingly the lending world has kept up with. Usually the mortgage side of the business is very slow to adapt. In a lot of areas it still is, with a lot of the things that we have to go through. But thankfully, they've been able to keep up with a lot of the alternative income situations. So there are programs out there for people that are Uber drivers. We usually want to see a 2-year history, but there's programs that we can qualify people just based off of 1099s, or if they are writing everything off on their tax returns, which is very typical of a self-employed person, realtors included. I work with a lot of realtors that when you do your tax returns, the part of the benefit of being self-employed is that you can write off all those business expenses. But the downside of it is, for mortgage qualification, is that your bottom line income isn't enough to qualify. So, I mean, I was looking at somebody's tax returns yesterday. They're an orthodontist. They're grossing like $500,000 from their business, but they write themselves a W-2 every month for $5,000 a month. So we all know what level that would qualify them for, right? They have in their head, I'm making all this money from my business, but now we're working in the opposite way, right? They've convinced themselves, I'm this high earner. They send me in their tax returns. I evaluate the tax returns, and you're a W-2 employee for yourself. So everything else is a write-off. We don't have enough income to use. And the solution for that is to use a bank statement program. So there are programs, just like we can qualify people off just their 1099s. We don't have to look at tax returns, or we can qualify people just off their bank statements. If they provide 2 years of bank statements and we can show $400,000 a year in deposits, then we can qualify them off of a much higher amount. There's ratios and expenses that we have to take into play, but that's 400,000 is a much better number to work with than somebody who's making 60 grand a year W-2 from their own business. So the point of this is that just to, again, give you some ideas of all the programs that are available. When somebody comes to you and says, I don't think I can qualify, I'm self-employed, or you're having the conversation and you start to talk about income. Oh, I own a restaurant. Oh, my wife drives for Uber. We can't use her income. Or, we have this other business on the side. I have an NFT business, or whatever people are into right now. If they're making income and showing it for a consistent amount of time, then there's ways that lenders can put together programs to qualify them. And that leads me to the last point of these 3 pillars of the pre-approval is the down payment, right? There's a lot of myths around down payment. People for years and years have been told that they need 20% down. 20% down is a great idea for some people because it gets rid of PMI, right? Everybody's got this negative impression of PMI, private mortgage insurance. What that is, just a real quick refresher on PMI, is it's an insurance policy that the bank makes you buy to protect them against your default. So the best way to think about it is if you're the bank and you're loaning somebody money and it's a high risk loan, anything less than 20% down is in the high risk category. that you are required to pay for the bank's insurance to cover your default. So it's a hard concept to get across to people sometimes, that you're paying for the bank's insurance policy against your own default. It is, it depending on the size of the loan and the credit report, it can be 200, 400, sometimes more a month. But it is one of the tools that we can use that's necessary in the business. It's just a requirement. If you're putting less than 20% down, you'll typically have to have PMI, and that's for conventional loans and for FHA loans. There's different rules on how much you have to have. So PMI is an important part of the payment. And since we're talking about the down payment amount, that's what determines the amount of PMI. So that's the reason that this myth is out there that you have to have 20% down to qualify for a mortgage. So we can just dispel that. Yes, there's reasons you want to put 20% down, but hey, in this market, instead of buying one house with 20% down, maybe you can buy two houses with 10% down and start to build your equity in multiple properties. And there's a lot of different strategies to use with how you want to position your cash. So to go through some different down payment options for first-time buyers, that's defined as somebody who hasn't owned a home in 3 years. So could be anybody. It doesn't have to be somebody who's never owned a home. They just can't have owned a home in the last 3 years. They qualify for first-time home buyer benefits. And again, lots of myths around what that means. Everybody asks me, oh, can I qualify for a first-time home buyer program? They think there's lower rates. They think there's, free money. That's all marketing. Those things do exist with some programs, but it's more about this first-time home buyer benefit. The biggest benefit is that you can have a 3% down payment, that you can come in with less cash. That means, you're going to have to pay PMI. Your payments might be a little higher, obviously, if you're putting less down, but it's one of the tools we have for people that don't have a lot of savings. They can put this 3% down and qualify as a first-time home buyer. The next option is 5% down. If you're not a first-time home buyer, the minimum down payment is typically 5%. In our market here in San Joaquin County, 5% is difficult because of our county loan limits, and we can get into that in another conversation. But the old ways of lending with no money down and no income verification, all that went away in 2013, which thank goodness. So we don't get ourselves into the same kind of situation we were in back then. But there are still programs that you can put 5% down up to any loan amount, even jumbo loans. If it's structured the right way, it might take 2 loans to get to the amount that we want to get to, but there are still options for 5% down. And then anything above that is acceptable. So the point of this is that when people are talking to you, oh, I need to save for 6 more months, or, I don't know if I can take a loan against my 401k, which is a great way to fund your down payment. To have the knowledge to tell them, no, you don't need 20% down. It could be as little as 3% down. And there are lots of different sources you can use for down payment. One of those is a retirement account. The great thing about borrowing from your 401k, if people have jobs that they've got money in their 401k in their retirement, if you borrow money from your 401k, you're going to pay it back through your payroll, and you're paying yourself back with interest. So the reason that that's important is because it's a loan from yourself. You don't get hit with that debt on the income calculation. It doesn't show up on your credit. It does show up on your pay stub. So we'll have to explain it to the underwriters what's going on, but that's not counted against you in your debt qualification ratio. So I've had people that have taken a loan from their 401k to pay off a car to get rid of that $500 payment and boost their buying power by another $100,000, because that 401k debt that you're paying back each month, that doesn't count in your debt ratio. So that's a great way if people have some money there. There's obviously different rules. You have to check with the employer. We always have to see what the terms are for that withdrawal. Usually people can take up to 50% of what's in their 401k. If they've got 70K in there, they can take 35 grand out to help them with the down payment, and it doesn't impact their numbers. Of course, yeah, they have to pay it back. Otherwise there's tax penalties, but it's a great tool to use. Another tool for down payment is gift funds. So, I work with buyers all the time that are getting gift funds, a lot of them from out of the country, from friends, relatives, family members outside of the country. The rules for gift funds are that it has to be from a family member who's related by blood or marriage. And there's typically no limit on how much the gift funds can be. They can give your whole down payment. They can cover the closing costs. They can, give a gift of whatever they want, but it has to be somebody that's related by blood or marriage. So, some families have lots of cousins, and cousins are definitely in that category of being related by blood or marriage. So, That's a great tool to advise your buyers. Oh, you don't think you have enough money saved? Is there somebody in your family that might be willing to give you a gift to help out? Have you looked at your 401k? Are there other sources that you might be able to get together? The hardest one to do is cash. If people have cash saved in their safe at home, that's one of the hardest things to use for a down payment. Usually the banks want to see that it's been in the account for 2 months. It's called seasoning. That if the money has been on the bank account for 2 months as a running balance, then we don't have to explain where the deposit came from. If there's a big deposit, then we have to explain where that came from. And again, there's other strategies. I had somebody who was a big casino winner. They bought a house a couple months ago and they wanted to use the cash that they had stacked in their safe at home. They'd won like $50,000 on slot machines over the last 3 months. They had all this cash, and because they were able to show the 1099s, I think it's 1099 that they get from the casino, the cashier, they don't get a check. They usually get cash when you cash out of the cashier at casinos. So they had all this cash stacked up, and that we were able to trace it back and match up deposits from their cash that they took to the bank during the transaction, and we got that approved through the underwriter. So it's all about having creative solutions, working with people that are willing to go that extra mile to help people that don't always fit in the same cookie cutter mold, and also to help them dispel these myths right up front so they don't get discouraged and stop the process. We all know how competitive it is. We want to give people the knowledge and confidence that they can be successful in this market. So that's the topics I wanted to cover today. Thanks, Ron. Do you have any other questions or comments?
Crypto.
Yep.
Let's say people are doing crypto and they want to cash out. What is the process for something like that?
So the great thing about most of the crypto platforms now is that they actually have good online records, right? If you log into your crypto account, you can see all your transactions. You can, some of them even have monthly statements that you can produce. So as long as we can trace it, crypto is perfectly fine. If we can trace where the money came in from their account, and if it's grown, that's perfect. If it's sitting in, it's just like any other investment account as far as the lenders are concerned right now, the underwriters. So no problems.
And then I remember many years ago, certain nationalities didn't trust banks, right? So they were very cash heavy. So what are you advising in time of those people? Is it just you got to put the money in?
Yeah. So for those
doing in those cases.
Yeah, in those cases, we try to meet that 2-month rule if we've got enough of a runway for them to deposit the money and then get 2 bank statements that show they have the running balance. That's the best way. Another option is if that cash is at home and maybe their parents live with them and their parents can give them a gift of cash that they can deposit. So an important distinction, and we didn't get into all the different loan types, but for FHA and VA, we have to verify who's giving the funds, that they had that money in their account. That's government loan rules. We have to verify the source of the funds for the gift.
Right.
For conventional loans, we don't have to. So anybody can give a gift that's family by blood or marriage, and we don't have to see their bank statements. So the strategy that I usually use if somebody has a lot of cash like that is that if it's their family member's money and they deposit it in their account, then we don't have to trace all that. They can send it directly to the title company right before closing, and that can qualify as a gift from family. And that's the other mistake that a lot of people will make during the transaction when it comes to down payment and gifts, is they'll start moving money around. They'll start making it really difficult to trace all these deposits and where things come from. So I usually tell them, don't do anything until I put together the plan for all of us. And usually it's going to be having the gift donor wire the money directly to title at the end of the transaction. As long as the wire name coming into title matches what's on the gift letter, then we don't have to provide any bank statements. We don't have to show the intermediary transfers to the client and then, using 4 different accounts to accumulate gifts. If it all just goes to the title company, it makes things a lot more smooth.
Awesome job, Seth. Last question is, what are you hearing about interest rate hikes today? Because I know it's changed in the last week.
Yep. So the common myth, again, I'm all about myth busting and dispelling what people get in their heads from the media and from online. So most people think that the Fed funds rate, which everybody talks about, the Fed's going to raise rates, that is mortgage rates. And it's obviously not. Mortgage rates aren't 0% or 0.25, which the Fed has been holding rates at for the last couple of years, right? So mortgage rates are usually determined by the bond market, long-term bonds, 10-year and longer. But those bond markets are affected by the Fed funds rates. They do impact the mortgage rates, but it's not a direct thing. When you hear the Fed is raising rates a quarter or half a point, that doesn't mean mortgage rates are going to do that. So it has an impact on the bond market, which is the important distinction. And what I'm hearing and what we've seen already is the Fed put out there that they were going to raise rates 0.5%, which is the biggest jump in years, to raise that in one shot. So the market started to react to that. The bond market started to build that in. Mortgage rates started to go up. We've seen a 1% rise in mortgage rates in the last 3 months, basically, even shorter window, maybe month. It's gone up 0.5 to 1%. So we're around 4% right now for mortgage interest rates for most scenarios. And what's going to happen now? The Fed is going to announce that they're only raising rates 0.25 point. That's their meeting this week. So the market's already built in this 0.5 point increase that everybody's been anticipating. So what should happen is that rates will start to come down a little bit over the next couple of weeks. Nothing dramatic. And the other thing that's the wild card is inflation and global events, right? This war in Russia and Ukraine, that is driving things in a direction that we can't predict. And the normal technical indicators and bond reactions are going haywire, that we just don't know what's going to happen. Usually when you see the stock market go down, that's good for interest rates because people are putting money into the bond market, mortgage interest rates start to come down. So everything's kind of out the window on that. As a long way to answer your question, what I'm telling people right now is take whatever the market interest rate is. The house is the product. The mortgage is the tool to get there. We can always restructure and refinance later. The consensus in the mortgage world and the bond world is that rates will continue to go up in 2022. We'll get into an official recession based on other economic indicators that define what a recession is. And when we're in a recession, rates always come down. If you look at the last 100 years of history, every recession, interest rates start to come down, and that's the tool that the government has to help in the economy, and housing will stay strong because of supply and demand. So interest rates will go up. Don't pay points. Minimize your fees on any mortgage transaction. Don't try to get the lowest interest rate. Go with whatever the market rate is and look at 6 to 12 months later, refinancing. Maybe it costs you a couple $100 more a month, but it's not worth paying thousands just to try to buy a rate down that's going to be lower in the future. That's my opinion.
Awesome. John had a question. What if they have cash in a safe deposit box? Could the bank verify the cash in the box with the owner?
The problem is that the bank doesn't know where that cash came from. So, you know, the illicit transactions are a big thing that changed after 9/11. And that's where a lot of these cash deposit rules come from, is the Patriot Act, right? So you can't be doing anything illegal or getting money from foreign sources that are banned by the US. So that's where these cash rules come in. So a safe deposit box would fall into the same category as a safe at home or mattress money, that there would need to be another solution or it needs to get deposited and seasoned for 2 months if you're trying to avoid scrutiny of it.
Great job, Seth. Thank you so much.
My pleasure. Okay, thanks. Great to see everybody. I'm going to drop off now. All right, take care. Yep.
Have a great weekend, everyone.
Bye-bye.